Welcome to the deep dive. Today we're cutting through the complexity of something that can really boost your financial health. Net operating losses, or NOLs. Think of
Right.
it as, turning a tough year into a powerful tax-saving asset.
Exactly. Yeah, many of us naturally focus on increasing income, right?
Mhm.
But what happens when unexpected expenses or maybe a downturn mean your deductions actually outweigh your revenue?
Right.
That's where an NOL steps in. This deep dive is all about understanding what an NOL truly is, how to pinpoint its exact amount using Form 172, and crucially, the strategic ways you can leverage it to reduce your tax burden,
Okay.
both, in the past possibly and definitely for years to come.
So our mission today is basically to demystify this Form 172 and its instructions. We want to guide you through the process, item by item, of identifying, calculating, and ultimately using an NOL as a really powerful tax-saving tool.
Mm-hmm.
Consider this your shortcut, maybe, to mastering a key aspect of tax strategy. It's about transforming a challenge into an opportunity.
Yeah, that's a good way to put it. We'll be navigating the intricacies of the December 2024 revision of Form 172 and its accompanying instructions.
The latest stuff.
Exactly. Specifically tailored for individuals, estates, and trusts. So this is the current information, straight from the IRS, designed to help you precisely figure your loss and hopefully maximize your tax benefits.
Okay, let's unpack this then. What exactly is a net operating loss? It sounds a bit, intimidating.
It can sound that way.
But from what I understand, it's really about turning a difficult year into a future advantage. Can you give us the sort of simplest explanation?
Sure. At its core, a net operating loss happens when your qualifying deductions for a tax year are greater than your income for that year.
Okay.
It's essentially a significant business loss or certain other qualifying losses that the IRS allows you to carry to other tax years.
Carry, like move it.
Yeah, move it either backward in time sometimes or forward into the future. And you use it to offset income in those other years. So this reduces your taxable income in those other years. And, by extension, it significantly cuts down your tax liability.
So it's like getting a credit for a bad year that you can use later.
That's a great way to think about it, yeah. A credit you can use to pay less tax when you have a good year.
So it's not just, oh, I spent more than I earned this year, right? There have to be specific kinds of losses that actually qualify for this tax relief.
Absolutely crucial distinction.
Yeah. Like, if I just made some bad stock picks, does that create an NOL?
Generally, no. Not all losses count equally towards an NOL. And that's exactly why Form 172 exists. It's the specific blueprint, the worksheet really, that individuals, estates, and trusts use to calculate the precise amount of NOL available.
Okay.
It helps you sort through different types of income and deductions to make sure only the qualifying ones contribute to this valuable tax asset.
Right. This raises an important question then. What typically triggers an NOL and what kind of losses actually qualify? Let's imagine we're helping Sarah. She's a graphic designer, maybe freelance. And this year, she unexpectedly faced a massive equipment failure. Maybe her main computer died, and she had some big client cancellations. Her business took a significant hit.
Yeah, tough year.
Yeah, she's staring at a big loss on paper. Would that qualify?
Sarah's situation is, a perfect example of a most common cause,
Hmm.
a loss from operating a trade or business.
Okay.
That's definitely the most frequent trigger for an NOL. But the instructions also specify other types of losses that can contribute.
Like what else?
Well, for individuals, estates, and trusts, these can include casualty and theft losses, but only if they result from a federally declared disaster.
Oh, okay. So not just any storm damage.
Right, federally declared disaster.
Yeah.
Also, for certain years, moving expenses and losses from work as an employee could qualify. But it's important to note, for most taxpayers, from 2018 through 2025, those specific deductions are generally suspended.
Good point. Things change.
They do. And losses from rental property can also contribute to an NOL. So it's broader than just a traditional business downturn. It really captures significant financial setbacks that genuinely impact your ability to generate income.
That's a helpful clarification. What about partnerships or S corporations? If Sarah was running her graphic design business as an S corp, would the S corp itself claim the NOL?
Good question. No, partnerships and S corporations generally can't use an NOL themselves. They're pass-through entities.
Right, right.
So the loss flows through to their owners. So Sarah, as the shareholder of her S-Corp, would use her individual share of the business's income and deductions on her personal return to figure her individual NOL.
Ah, okay. So the benefit still happens, just under 1040.
Exactly. It accrues at the individual taxpayer level. That's a key point for small business owners structured that way.
Okay. So before we dive into the actual numbers and the form lines, what's the big picture strategy? How do you figure out and use an NOL? Give us the roadmap, those crucial steps that turn a loss into a tax-saving opportunity.
Yeah, the IRS instructions lay out a pretty clear 5-step roadmap.
Yeah.
It's designed to guide you systematically and help you maximize the benefit.
Okay, step one.
First, step 1, complete your tax return for the year. This is your initial check.
Just do your regular taxes first?
Exactly. For individuals, you need to see if you have a negative amount after subtracting your deductions standard or itemized from your adjusted gross income, your AGI.
Okay.
For estates and trusts, it's looking at taxable income after certain adjustments. This step just tells you if you're even in a loss situation, that might lead to an NOL.
Got it. Initial check. Step two.
Then, step 2, determine if you actually have an NOL and its specific amount. This is where Form 172 Part I comes in, which we'll break down in detail.
Still that calculation part.
Right. If after these specific calculations you find out you don't actually have a qualifying NOL, well, the process stops there for this year.
Makes sense. Okay. Step 3. Assuming you do have one.
Okay, step 3. If you do have an NOL, you make a critical strategic choice. Carry back versus carry forward. This decision impacts when you get the tax savings.
When you use the loss.
Exactly. Now, for most NOLs arising after 2020, the general rule is carry forward only.
Okay, so usually you use it in the future.
Usually. However, there's that significant exception we touched on, farming losses. Certain farming losses can often still be carried back 2 years.
Ah, the farming exception.
Yeah, it's a powerful tool. So your choice here can dramatically affect your immediate cash flow versus your future tax planning.
Big decision then. What's step 4?
Step 4, deduct the NOL. Once you've chosen your strategy carry back or carry forward, you apply that calculated NOL amount to the tax return of the selected year or years.
Okay, actually use it.
This is the moment you actually see the reduction in your taxable income on that year's return.
Nice. And last step, step 5.
And finally, step 5, figure any unused NOL. It's pretty common for an NOL not to be fully used up in the first year you apply it.
Right, if the loss is bigger than the income that year.
Precisely. So you carry the remaining amount over to the next tax year. You continue this process, carrying it forward year after year until the entire NOL is fully absorbed.
So it can benefit you for multiple years.
Absolutely. It can be a multi-year benefit, effectively reducing your taxable income over several periods until the loss is exhausted.
Yeah.
It turns that single difficult year into a more lasting tax advantage.
Okay, that roadmap makes sense. But you mentioned qualifying deductions earlier. I assume not everything counts.
That's right. It's vital to understand that not all deductions count towards calculating an NOL. The instructions are very clear on what you cannot include.
Okay, what's that?
These are critical exclusions really designed to ensure the NOL deduction targets specific types of losses and, frankly, to prevent common errors.
Good to know the pitfalls.
First, you cannot include capital losses that exceed your capital gains.
Ah, back to the stock example.
Exactly. If our graphic designer, Sarah, also had significant personal stock losses that were more than her stock gains, that excess loss amount, it cannot contribute to her NOL. The IRS generally wants the NOL focused on operational or qualifying disaster losses, not primarily investment setbacks.
Got it. What else?
Second, the Section 1202 exclusion for qualified small business stock gains. This is a nice tax break on gains from certain small business stock, but you can't use it and have it reduce your income for NOL calculation purposes. It gets added back, effectively.
Okay, no double dipping there.
Right. Third, and this is a big one, non-business deductions exceeding non-business income are excluded.
Explain that a bit more.
Sure. Your personal deductions, things not connected to your trade or business, like most itemized deductions or the standard deduction, if they add up to more than your non-business income, like interest or dividends, that excess cannot create or increase an NOL.
So my personal spending can't usually create this business-focused loss.
Generally, no. That's the idea. Fourth, you cannot include the NOL deduction itself from other years.
Okay, that makes sense.
When you're calculating a new NOL for the current year, you don't factor in any NOLs you're carrying over or back from previous years. It's only about this year's new loss figure.
Right, clean calculation for the current year.
Exactly. And finally, the Section 199A deduction for qualified business income, QBI. that common deduction for pass-through businesses. Also not allowed when figuring an NOL.
Okay, quite a few things to exclude.
Yes, and understanding these exclusions is vital for getting the calculation right and avoiding problems later. Knowing what doesn't qualify is just as important as knowing what does.
It really stops you from overstating your loss, which could cause issues down the road.
Okay.
Let's get into the form itself then. This is where we actually figure out the NOL amount, right?
Correct. Part 1 of Form 172 is the worksheet where you crunch the numbers to arrive at that potential NOL figure. Getting each line right here is crucial for accurate tax savings later.
All right. First things first, the top section.
Yeah, before you hit the calculation lines, you fill in the standard header info, your name, Social Security number, or employer ID number, EIN, for estates, trusts, address, and the tax year you're figuring the NOL for.
Okay.
And don't forget to check the box if it's a calendar year or specify the dates if it's a fiscal year. Seems basic, but it ensures your NOL is correctly linked to your tax profile for that specific year.
Right, basics first. Okay, let's walk through part 1, line by line. Maybe focus on why each line matters for that final NOL figure.
Sounds good. Line 1 is your starting point. For individuals like Sarah, you'll take your adjusted gross income, that's your total income, before certain key deductions, and subtract your standard or itemized deductions from your Form 1040.
Okay, AGI minus deductions.
Right. For estates and trusts, it's slightly different. It's their taxable income adjusted by adding back certain deductions like charitable contributions, income distribution deductions, and exemption amounts.
So this line gives you that initial income or potentially loss figure before we make all the specific NOL adjustments.
Exactly. It's that first check. If this number isn't negative, you probably don't have an NOL to begin with.
Gotcha. If it is negative, we keep going. What's next? Lines 2 through 5.
Yes, lines 2 through 5 deal with your non-business capital gains and losses. This section is key because, as we said, the IRS wants to separate personal investment results from business operating results.
Right.
On line 2, you enter your non-business capital losses, but as a positive number. And remember, don't include any Section 1202 exclusion amounts here.
Okay, losses as positive, line 3.
Line 3 is for your non-business capital gains. Again, enter this without regard to any Section 1202 exclusion.
Got it. And lines 4 and 5.
Lines 4 and 5 are calculation lines. They basically determine if your non-business capital losses, line 2, are more than your non-business capital gains, line 3, or the other way around.
Okay.
The fundamental rule here, and this trips people up sometimes, is that non-business capital losses can only be deducted against non-business capital gains when figuring an NOL.
Only up to the amount of gains.
Exactly. Any excess non-business capital loss cannot be used to create or increase your NOL. So, a huge personal stock market loss won't automatically generate a big NOL if you didn't have offsetting non-business gains.
Okay, that really hammers home the distinction between personal investments and business operations for NOL purposes. They don't want big market swings creating artificial business losses.
Precisely. The IRS is very clear on that. Next up, lines 6 through 10. These deal with non-business deductions and income other than capital gains. Another critical section, and honestly, another area where mistakes can happen.
All right, line 6, non-business deductions.
Line 6, non-business deductions, is where you enter deductions that are not connected with your trade or business. Again, enter it as a positive number.
So what counts as non-business here?
Think about things like your health savings account, HSA deduction, traditional IRA deductions, alimony paid, if applicable under current rules, and most of your itemized deductions from Schedule A.
Most itemized. What's excluded?
Good catch. The main exceptions are those federally declared disaster casualty theft losses we mentioned earlier, and any state income tax you paid on your trade or business income. Those are treated as business-related. But other itemized deductions like medical expenses subject to limits, state and local taxes not related to business income, home mortgage interest, charitable contributions, those are generally non-business.
A standard deduction, if you take that instead of itemizing.
Yes, the standard deduction is also considered a non-business deduction and would be included on line 6.
Okay, that's a crucial split. So what are considered business deductions then? The ones that do not go on line 6 but are obviously important for the business's bottom line.
Excellent question, because clear classification is key. Business deductions are entirely separate. For Sarah's graphic design business, this would be things like state income tax on her business earnings, maybe educator expenses if she taught a design class, the deductible part of the self-employment tax, self-employed health insurance premiums.
Yeah.
Also critically, Any rental losses, losses from selling business property, her share of any loss from her S-corp, like in our example, losses on Section 1244 small business stock.
Wow, lots of possibilities.
And as mentioned, those federally declared disaster casualty theft losses, even on non-business property if you itemize, are treated as business deductions for NOL purposes. Basically, anything truly tied to operating your trade or business is a business deduction and is not entered here on line 6.
That's a really helpful list. It really emphasizes how carefully you need to classify everything. You can't just lump all expenses together for this calculation.
Absolutely not. Okay, then on line 7, non-business income other than capital gains, you enter income that is not from your trade or business.
Examples.
Think taxable IRA distributions, pension benefits, Social Security benefits, the taxable part, annuity income, ordinary dividends, interest earned on personal savings or investments, your share of non-business income from partnerships or S-corp.
So basically, income not from your main business activities. What about income that is from the trade or business, like Sarah's client payments?
Right. Business income like salaries, wages, self-employment income like Sarah's design fees, unemployment compensation, rental income, gains from selling business real estate. That income is not entered here on line 7. It's part of your overall AGI calculation back on line 1, but it's specifically excluded from this non-business income line.
Got it. So lines 8, 9, 10.
Lines 8 through 10 are then calculations to see if your non-business deductions exceed your non-business income. Line 8 combines your non-business capital gains not used up by non-business capital losses from line 5 with your other non-business income from line 7.
Okay.
Line 9 is really important. It's calculated only if your total non-business deductions, line 6, are more than your total non-business income. Line 8, the difference goes here. This amount effectively reduces your potential NOL, or increases the income you need to overcome before having an NOL.
Why does it reduce it?
Because it represents non-business deductions that didn't have enough non-business income to offset them. The rule is you can't use purely non-business deductions to create or increase an NOL unless you have the non-business income to cover them first.
Ah, okay.
What?
That's a subtle but key detail. It stops you using personal deductions to create a business loss unless you had personal income too.
Exactly. Line 10 calculates the excess non-business income, if any, which might be used later against business capital losses.
Oh, wait, this is intricate. What's next? Lines 11, 14.
Now we switch back to the business side, specifically lines 11 through 14, which handle business capital gains and losses.
Okay.
Line 11, business capital losses.
Yeah.
Enter your business capital losses here as a positive number. Line 12, business capital gains. Enter your business capital gains, again, without regard to any Section 1202 exclusion. Lines 13 and 14 calculate how much of your business capital loss can be deducted. Line 13 adds your business capital gains, line 12, to any excess non-business income calculated on line 10. Line 14 is then calculated only if your business capital losses, line 11, exceed that line 13 total. The difference here is a loss amount that can contribute to your NOL calculation. It ensures business capital losses are only deducted after accounting for available business gains and any leftover non-business income.
Got it. Lots of netting going on.
Yes, a lot of netting and specific ordering rules. Okay, line 15 is just a simple sum of line 4, excess non-business capital loss over gain, and line 14, excess business capital loss after netting.
Okay.
Now, line 16 requires you to look at your Schedule D. You enter any combined net capital loss, short-term and long-term, from your Schedule D, Form 1040, or Schedule D, Form 1041 for states trusts. Enter this as a positive number.
The overall capital loss limit from the main tax form?
Essentially, yes.
Yeah.
If you don't have an overall capital loss on Schedule D, or if you don't have a Section 1202 exclusion, you might skip line 17 through 21 and go straight to line 22.
Okay, but if you do have those...
Then line 17, Section 1202 exclusion, becomes crucial again. You enter as a positive number any gain you excluded under Section 1202 on qualified small business stock. As we said, this exclusion isn't allowed with figuring an NOL, so it gets added back here.
Right, removing that specific tax break for this calculation.
Correct. Lines 18 through 21 then work through the interplay between your total capital losses, the Section 1202 exclusion, and the annual capital loss limitation. Usually $3,000 for individuals, $1,500 if married, filing separately.
The $3,000 limit against ordinary income.
Exactly. These lines essentially figure out how much of your capital loss is disallowed for NOL purposes because of either the Section 1202 exclusion needing to be added back or because the loss exceeds the annual limit. The result on line 21 represents the capital loss limitation adjustment needed for the NOL calculation.
So even with big capital losses, only a limited amount might actually help the NOL calc because of these specific rules and limits. It really emphasizes the focus on operating losses.
Precisely. It's a key safeguard in the calculation. Now, line 22 is just adding lines 15 and 21 together.
Okay.
Line 23, NOL deduction for losses from other years, is straightforward. As we mentioned in the roadmap, you cannot deduct any NOL carryovers or carrybacks from other tax years when calculating the current year's NOL.
Right.
This line exists simply to add back any such deductions if you happen to claim them on your main tax return for the current year, ensuring you're only calculating the new loss generated this year.
Got it. Isolating the current year's NOL.
Exactly. And then we arrive at line 24, the final NOL calculation.
The big moment.
Indeed. You combine the figures from lines 1, your initial loss, 9, the non-business deduction limitation, 17, the section 1202 add back, 21, the capital loss limitation add back, and 23, adding back NOLs from other years. You essentially take your initial loss from line 1 and add back all these disallowed items.
Okay.
If the final result on line 24 is less than 0, congratulations, you have a net operating loss for this tax year.
A negative number means success here.
In this context, yes. If the result is 0 or more, then despite having a loss on line 1 perhaps, after all the adjustments, you don't have a qualifying NOL for the year.
So after all those detailed calculations in part 1, when that line 24 number finally turns negative, what does that truly signify for the taxpayer? For Sarah, our graphic designer, what's the magic here?
Well, for Sarah, hitting a negative number on line 24 means she has a legitimate calculated net operating loss. It validates that her tough business year resulted in a loss recognized by the tax code as something special.
Okay.
It means she now holds a powerful tax-saving asset. This isn't just an accounting entry. It's potentially a refund check for past taxes she paid, or a significant reduction in the taxes she'll owe in the future. It's the payoff for carefully navigating Part 1, turning that financial setback into a tangible opportunity for tax relief and, hopefully, financial recovery.
Does that make sense? It's the official stamp saying, yes, you have this tool available now. Okay, so with that critical NOL figure finally calculated, the real strategic chess match begins, right?
You're absolutely right.
The next move is maybe the most impactful, deciding when and how to deploy this NOL. This is where Sarah really starts seeing the potential savings.
Yes, the decision of when to use your NOL is critical for maximizing its value. And the rules have changed over the years.
How so?
Well, for most NOLs arising in tax years after 2020, the general rule is you can only carry them forward to a later tax year.
Only forward, no going back.
Generally, no going back for most situations anymore. This means you use the loss to offset income in future years, reducing your taxable income in those subsequent periods until the NOL is fully used up.
That's a big change. I definitely remember rules allowing carrybacks more broadly before.
Yes, you're right. Before the Tax Cuts and Jobs Act, TCJA, and subsequent legislation like the CARES Act, which temporarily modified things, carrybacks were more common. But the default rule now, post-2020, is carry forward only.
But you mentioned an exception.
Ah, yes, the crucial exception. It remains. Certain farming losses may still be carried back 2 years.
2 years back for farmers.
Yes. This is a really significant benefit specifically for farmers. It allows them to potentially get a refund for taxes paid in the prior 2, possibly more profitable years.
Yeah.
It can provide immediate cash flow relief, which, as you can imagine, is often vital in agriculture.
That sounds fantastic for farmers. What exactly counts as a farming business, though? Is it just growing crops?
It's defined pretty clearly. A farming business includes cultivating land, raising or harvesting agricultural or horticultural commodities. Think nurseries, sod farms, raising trees bearing fruit or nuts.
Okay.
It also includes raising, shearing, feeding, caring for, training, and managing animals.
Livestock, too.
Yes, but importantly, it generally doesn't include contract harvesting for someone else if you don't bear the risk, or just buying and reselling plants or animals that were entirely grown or raised by somebody else. You need to be involved in the production risk.
Got it. Active farming and the farming loss itself.
The farming loss amount eligible for the carryback is the smaller of 2 things. Either the NOL calculated using only farming-related income and deductions, or your total NOL for the entire year from all sources.
Okay, so it's capped by the overall NOL.
Correct. This ensures only the portion genuinely attributable to farming gets that special 2-year carryback treatment.
Still, that could mean immediate cash back, a fantastic tax-saving strategy, especially given how unpredictable farming can be.
It truly is a valuable provision. Now, there's another important rule to discuss, particularly for NOLs carried forward to years after 2020. It's called the 80% limitation.
80%, what does that limit?
For NOLs arising in tax years starting after 2017, when you carry them forward to a tax year starting after 2020, the amount of NOL you can deduct in that future year generally cannot exceed 80% of your taxable income for that year.
Okay, wait. So even if my NOL carry forward is huge, I can only use it to wipe out 80% of my income in a future year.
Exactly. You calculate that future year's taxable income before taking the NOL deduction itself and also before the qualified business income, QBI deduction, and certain other specific deductions. Your NOL carryforward deduction is limited to 80% of that figure.
Huh. So 20% of my income in that future year will still be taxable, even with a large NOL carry forward.
That's generally the case under this rule.
Hmm.
It means you might need more years to fully utilize a large NOL, as you can't zero out your income completely in any single year just using the NOL carry forward subject to this limit.
Yeah.
It stretches the benefit out.
That's a really important cap to be aware of for planning. Okay, back to the farming exception. If a farmer can carry back, do they have to?
No, they don't.
Yeah.
Even if you have a farming loss that could be carried back 2 years, you have a choice. You can elect to waive the carryback period and only carry the entire NOL forward.
Waive it. Why would someone give up the chance for a quicker refund?
It comes down to strategic tax planning. Maybe you expect to be in a significantly higher income tax bracket in future years compared to the 2 prior years.
Ah, so the deduction is worth more later.
Potentially, yes. Carrying the NOL forward to offset income tax at those higher future rates could result in greater overall tax savings, even if you wait longer for the benefit.
Makes sense.
Or sometimes it might just be simpler to avoid amending past returns and just deal with it going forward.
How do you make that waiver?
It's very specific. You must attach a statement to your original tax return filed by the due date, including extensions, for the year the NOL occurred.
On the original return.
Yes. The statement needs to clearly say you are electing to waive the carryback period under Internal Revenue Code, Section 172B3.
What if you forget to attach it?
There's a limited relief window. If you filed your original return on time but missed the statement, you generally have 6 months from the original due date of the return, excluding extensions, to file an amended return, Form 1040X, for the NOL year, attaching the required statement. You have to write "Filed pursuant to Section 301.91002" at the top of the statement itself.
Okay, a tight window for corrections. And is this waiver decision final?
Yes. And this is the critical takeaway. The election to waive the carryback period is generally irrevocable.
Irrevocable. Wow.
Once you make that choice, you can't change your mind later and decide to carry it back after all. So you really need to think through the long-term implications, maybe run some projections, or get professional advice before making that irrevocable decision.
Definitely sounds like a major planning point. Okay, so how does the carryback carry forward actually work mechanically?
If you do carry back a farming loss, you must take it to the earliest year in the 2-year period first. So year 2 before the loss year.
Okay, start furthest back.
Yes. If the NOL is more than your modified taxable income, we'll get to that, in that earliest year, you then carry the unused portion to the next year, the year immediately before the loss year.
Right.
If there's still some NOL left after applying it to both carryback years, or if you waived the carryback, or if it wasn't a farming loss to begin with, then any remaining farming loss, plus any non-farm NOL, plus any excess business loss from the NOL year, all gets combined into your carry forward amount.
Okay, all the leftover loss goes forward.
Exactly. You start by carrying it to the first tax year after the NOL year. If you don't use it all up in that year, subject to the 80% limit we discussed, you carry the unused part to the next year, and so on. You keep carrying it forward until the entire NOL is used up. There's no longer a limit on how many years you can carry it forward, generally.
No time limit going forward. No, that's good.
Generally not for NOLs arising after 2017. They can be carried forward indefinitely until used up, subject to that 80% limitation each year.
Okay, that sounds like that multi-year chess game again. Always tracking the NOL, applying it optimally each year to reduce your future tax burden until it's gone. For Sarah, it's about leveraging that tough year for as long as possible.
That's the essence of it, yes. Strategic multi-year tax planning.
All right, strategy decided, NOL calculated. How do you actually claim this deduction? This is where the rubber meets the road, getting that tax saving applied.
Right, claiming it correctly is essential. If you are carrying back an NOL, typically that farming loss exception, now you have two main options for claiming the refund.
Okay, option one.
Form 1045, application for tentative refund. This is generally the faster way to get a refund from a carryback.
Faster sounds good.
It usually is, but you have a tight deadline. You generally must file Form 1045 on or after the date you file the return for the NOL year itself, but no later than 1 year after the end of the NOL year.
1 year deadline. Okay.
So if Sarah had a qualifying farming loss in, say, 2024 calendar year, she'd generally have until December 31st, 2025 to file Form 1045.
Got it. Any downsides to Form 1045?
Well, the refund is tentative. The IRS processes it quickly, but they review it more thoroughly later. If they find errors and determine the refund was too large, they can assess and collect that excess amount relatively quickly. You absolutely must attach your completed Form 172 to Form 1045.
Okay, faster but tentative. What's option 2 for carrybacks?
Option 2 is using Form 1040X, amended U.S. individual income tax return. You use this if you miss the Form 1045 deadline or just prefer not to use it.
The standard amended return form.
Exactly. The deadline here is longer. Generally, you must file Form 1040X for the carryback year within 3 years after the due date, including extensions, for filing the return for the NOL year.
3 years, much longer window.
Yes. But unlike Form 1045, which can cover multiple carryback years on one form, you need to file a separate Form 1040X for each carryback year you're applying the NOL to.
One amended return per year. Okay.
And for estates and trusts, they'd use an amended Form 1041 instead, checking this specific box for an NOL carryback. Again, you must attach Form 172 to each Form 1040X or amended 1041.
Got it. So 2 ways to claim a carryback refund. What about carrying the NOL forward? How do you claim that?
Carrying forward is generally simpler. For individuals like Sarah, you list the NOL deduction as a negative figure directly on Schedule 1, Form 1040, under Other Income. It reduces your overall income reported on Form 1040.
Just a line item on the regular return?
Pretty much. For estates and trusts, they include the NOL deduction on Form 1041, usually on the Other Deductions line. In both cases, individual or estate trust, you should attach Form 172 to your Form 1040 or Form 1041 for the year you are taking the NOL carryforward deduction. This shows the IRS how you calculated the NOL being used.
Okay, so getting the deduction correctly reported on the right form with the right backup is absolutely key to actually realizing the tax-saving benefit. Seems like careful record keeping and following instructions is paramount.
It truly is. Attention to detail here directly impacts your tax savings. Now, you asked earlier, what happens if your NOL is more than the taxable income of the year you're carrying it to?
Right, if the loss is bigger than the income.
That's where you'll generally have an NOL carryover to the next year. And to figure out exactly how much carries over, you need to calculate something called modified taxable income for the year you applied the NOL. This is done in Part 2 of Form 172.
Modified taxable income sounds like another special calculation.
It is. Think of it as the IRS doing a specific recalculation of your income for the year the NOL was being applied to. Its sole purpose is to determine how much of your NOL gets used up against that year's income, so you know how much is left to carry forward.
Why can't they just use the regular taxable income from the return?
Because regular taxable income might have been reduced by certain deductions that aren't allowed when figuring how much NOL gets absorbed. The modified taxable income calculation essentially adds back some of those deductions to get a baseline income figure against which the NOL is applied.
What kind of deductions get added back?
The main modifications for figuring modified taxable income are: 1, you can't claim an NOL deduction for the NOL you're currently figuring the carryover for, or for any NOLs from later years. Only NOLs from earlier years count.
Okay.
2, you generally can't claim a deduction for capital losses exceeding your capital gains. And your income must be increased by the amount of any Section 1202 exclusion taken that year.
Similar to the rules for calculating the NOL itself.
Very similar logic, yes. 3, for years when personal exemptions were allowed, you couldn't claim those when figuring modified taxable income.
Okay.
4, and critically, any item on your return that's affected by your adjusted growth income, AGI, things like certain itemized deductions, IRA deductions, maybe taxable Social Security, those might need to be refigured based on the AGI after making the modifications in points 1 and 2.
Wow. Okay, so it's like rerunning parts of your tax return with these specific NOL absorption rules applied.
That's a good way to think about it. It ensures the NOL is absorbed against a consistent income base and that you correctly track the remaining NOL amount.
Definitely sounds like a crucial calculation for that multi-year strategy. You need to know exactly how much NOL you have left for next year.
Precisely. And Part 2 of Form 172 is designed to walk you through this systematically. If you're carrying back, you complete one column for each carryback year, always starting with the earliest year first. If carrying forward, you'd use a similar calculation concept each year to track the remaining balance. Let's look at the lines for a carryback scenario in Part 2.
Okay, part 2. Line by line for a carryback year.
Line 1, NOL deduction, is where you enter the amount of the NOL you are carrying back to this specific year.
Okay, the loss amount being applied.
Line 2, taxable income before carryback, is key. You enter the taxable income from the tax return of that carryback year. But importantly, you don't adjust it for the NOL carryback you're currently applying on line 1. However, you do include any NOL deductions from earlier NOLs that were already allowed in that year.
Okay, and there was a note about zero income.
Yes, crucial point. If the taxable income reported on the original return for that carryback year was 0 or less, you must refigure it without limiting the result to 0, it could be negative, and enter that potentially negative number here. This ensures the NOL absorption is calculated correctly, even against a year that originally showed no tax liability.
Got it. Don't just put 0 if it was 0 or less.
Right. Lines 3, 4, and 5 are where you add back those disallowed items for absorption purposes, similar to Part 1. Line 3, net capital loss deduction. For individuals, you add back the net capital loss deduction claimed that year, usually up to $3,000. Enter as positive. Line 4, Section 1202 exclusion. Add back any Section 1202 gain excluded that year. Enter as positive. Line 5, qualified business income deduction. Add back any QBI deduction claimed that year under Section 199A. Enter as positive.
Okay, adding back those specific deductions.
Line 6, adjustment to AGI, is needed if you entered amounts on line 3 or line 4. Because those add bags increase your AGI for these purposes, you might need to refigure other items on the return that depend on AGI.
Like what?
Things like the special allowance for passive activity losses from rental real estate, maybe the taxable amount of Social Security benefits, IRA deduction, student loan interest deduction. You refigure these based on the higher AGI and enter the total net adjustment here.
Okay, recalculating AGI limited items.
Line 7, adjustment to itemized deductions. This applies mainly to individuals who itemized in the carryback year, especially if lines 3, 4, or 5 had entries. If so, you need to complete a detailed worksheet further down in Part 2, lines 1133, to calculate this adjustment. We can touch on that briefly.
Okay, line 8.
Line 8 is specifically for estates and trusts to enter their exemption amount, which also gets added back.
Got it. Then line 9.
Line 9, modified taxable income, is a sum of lines 2 through 8. This calculated number is the amount of income in the carryback year that your NOL on line 1 will actually offset or absorb. If this sum is 0 or less, you just enter 0 here.
So this is the number the NOL is applied against.
Exactly. And finally, line 10, NOL carryover to the subsequent year. You generally subtract line 9, the modified taxable income used up, from line 1, the NOL applied to this year.
The leftover amount.
Right. If the result is 0 or less, you enter 0. This figure on line 10 is your remaining NOL that gets carried over to the next year in the sequence, either the next carryback year or the first carry forward year.
Okay, that systematic approach makes sense. It ensures you use the NOL correctly year by year and track exactly what's left, maximizing the long-term savings until it's all gone.
That's the goal. Now, quickly on that adjustment to itemized deductions, lines 1133, section within Part 2.
Yeah, you mentioned that for line 7.
Right. This is mainly for individuals who itemized in the carryback year. Because the NOL carryback and the adjustments on lines 3 to 5 change your AGI, you might need to refigure certain itemized deductions that have AGI limitations.
Like medical expenses.
Exactly. Medical and dental expenses, lines 14-18, are recalculated based on the new modified AGI, potentially changing the deductible amount. Mortgage insurance premiums, lines 19-21, which were deductible before 2022, also had AGI phase-out, so those need recalculation. Charitable contributions, lines 25-27, are limited by AGI percentages, so those need refiguring. And there's a complex interaction. Any charitable contribution carryover from that year might be reduced if this recalculation allows more NOL to carry over.
Preventing a double benefit again.
Right. And casualty and theft losses, lines 28-32, also subject to AGI limits, need recalculating. The total adjustment from refiguring all these items feeds back into line 7.
So these detailed adjustments ensure everything is recalculated correctly based on the modified income picture after the NOL carryback, maximizing the correct refund or tax reduction. Another layer of precision needed.
It is. And one more complex area involves changes in marital status or filing status.
Oh yeah, what if you got married or divorced between the NOL year and the carryback carry-forward year?
It gets complicated, and this is often where professional advice is really helpful. The rules aim for fairness in attributing the NOL. If you and your spouse were not married to each other in all the years involved, generally only the spouse who actually had the loss can take the NOL deduction. If you filed jointly with a new spouse later, that prior separate NOL can usually only offset your share of the income on the joint return. You might need complex calculations, sometimes called mock separate returns, to figure this out. If you filed separately in the NOL year but jointly later, the separate NOL is generally treated as a joint NOL when carried to the joint return year. But if you file jointly in the NOL year and file separately later, you have to figure out each spouse's individual share of that joint NOL to see how much each can carry to their separate returns. Again, potentially complex allocations.
Definitely sounds like a situation where getting expert guidance is crucial to make sure life changes don't inadvertently mess up your NOL benefits. Your personal life really can impact your tax strategy here.
It certainly can. These allocation rules are designed for fairness but require careful application. Okay, shifting slightly beyond the core Form 172 mechanics, there's another limitation non-corporate taxpayers need to be aware of: excess business loss limitations.
Excess business loss. How is that different from an NOL?
It's actually a hurdle you might face before even calculating the NOL on Form 172. This limitation applies prior to the at-risk rules and passive activity loss rules.
Okay, so it comes first in the sequence.
Yes. An excess business loss occurs when your total deductions from all your trades or businesses exceed your total gross income and gains from those businesses, plus a specific threshold amount. That threshold amount is indexed for inflation, and you find it in the instructions for Form 461, which is used to figure this limitation.
So if my business loss is too big compared to my business income plus this threshold amount.
Exactly. The amount of the loss that is over that limit is considered an excess business loss.
And what happens to that excess amount? Is it just lost?
No, thankfully it's not lost, but it is disallowed as a deduction in the current year.
Okay, can't use it this year. Then what?
Instead, that disallowed excess business loss amount is treated as an NOL carryforward to the following tax year.
Ah, so it basically becomes part of next year's NOL potential.
Precisely. It gets added to any NOL carryforward you might already have, or starts an NOL carryforward if you didn't have one. But critically, when it is carried forward as part of an NOL, it's also subject to that 80% limitation we discussed earlier in the carryforward year.
So it's another layer that can delay the full benefit of a very large business loss, pushing some of it into future years.
Exactly. For Sarah, if her graphic design loss was exceptionally large in 1 year, she'd first figure this potential excess business loss on Form 461. Any disallowed amount there would then become an NOL carryforward, subject to the usual NOL rules in the future. It's a crucial step for businesses with significant losses relative to their income.
Good to know about that extra layer. Okay, any final reminders?
Yes, one absolutely vital final reminder: keep the hood.
Records. Always important with taxes.
Especially with NOLs, because they can span multiple years. The official guidance is you should keep records for any tax year that generates an NOL for 3 years after you have fully used the carryback or carryforward, or 3 years after the carryforward expires if you don't use it all up.
That could be many years after the loss year itself.
It absolutely could. Given that NOLs can now be carried forward indefinitely in many cases, you might need to hold on to those records for a very long time. Your documentation, proof of income, expenses, the Form 172 calculations for each year is your evidence supporting the NOL deduction claimed over potentially many years.
That makes perfect sense. Your documentation is your defense if the IRS ever questions it years down the road. It's really an investment in securing those future tax savings.
Couldn't have said it better myself.
Okay, we have really taken a deep dive into net operating losses in Form 172 today. We've looked at what an NOL actually is, how to meticulously calculate it using Part 1. We've understood the crucial strategic choices around carrybacks and carryforwards, especially that key farming exception, and walked through how to actually claim the deduction and manage the carryovers using Part 2. This really isn't just about filling out another tax form. It feels like understanding a powerful mechanism for genuine tax saving and financial planning.
I think that's right. Whether you've experienced a business downturn like our hypothetical, Sarah, or maybe a significant casualty loss from a disaster, or even if you're just planning for future business fluctuations, understanding NOLs is really crucial.
Yeah.
It transforms what feels like a difficult year into a future financial advantage. It lets you potentially reclaim taxes you've already paid or significantly cut your future tax bills. And this knowledge isn't just for accountants. It's really for any savvy taxpayer looking to optimize their financial situation and navigate the tax code effectively.
So, thinking about our listeners, what does this all mean for you? Maybe the next time you review your financials or if you face a tough year, don't just see a loss as purely a setback.
Right.
Try to see it as a potential opportunity, this deferred asset, waiting to be strategically deployed to help secure your financial future. How might knowing these rules reshape your approach to financial planning, especially when business is challenging? Does it maybe encourage you to be even more meticulous about tracking every single business expense?
It should.
Because maybe every receipt, every careful classification isn't just about this year's taxes, but about potentially building a powerful tax shield for years to come. Something to think about.
Definitely. And the IRS does provide more detailed guidance. Publications like Pub 536, Net Operating Losses, and Pub 225, Farmer's Tax Guide, offer even more specifics.
Good resources.
Always remember, though, consult the latest Form 172 instructions for the specific year you're dealing with, as rules can change. And seriously, consider getting professional tax advice for your unique situation, especially with the complexities around carrybacks, limitations, and life changes we discussed.
Sound advice. Thank you for joining us on this deep dive. Until next time, keep learning, keep questioning, and keep optimizing.